So good evening and welcome back. Today we are going to look at issues in capital budgeting, or you can say extensions of the capital budgeting process, the extensions. We're going to look at two extensions, one today and one the next week. Today we're going to look at sensitivity analysis, which is part of risks in capital budgeting. So when you do capital budgets, you have to also consider risk. Risk meaning that things may not be exactly what you have projected them to be. The forecast could be wrong. The forecast could be off. And then when you do the sensitivity analysis, you use that information to hedge against uncertainties, also to provide yourself potential opportunities and options to follow. So one way that we do sensitivity analysis is to first of all ask ourselves, what would be the break-even analysis? Or what would be the break-even output? What is to say, what is the minimum level of output that we need to produce in order to be able to make a profit? Now, that break-even is used also, is also studied when you study microeconomics, when you study cost accounting. But it's important in capital budgets because it enables you to have an idea whether, in fact, the NPV could be negative. For example, if you barely break even, more often than not, the net present value of your project is going to be negative. If you are producing at a level that is way above break even, and chances are that you will have a positive net present value. So the project that you are proposing will add value to the business. Okay. Now, a break-even analysis that we're going to do here is pretty simple. It can be a little bit more complex in terms of the calculations. We're going to say do a break-even analysis that is based entirely on a linear function, but sometimes you know that production functions and cost functions are not always entirely linear. Okay, they can be non-linear. But let's begin from basic linear functions, which present us with a simple representation of what break-even analysis means. So I'm going to share a screen, and okay, so this is what we're going to be talking about. Okay, so this is part of risk analysis in capital budgets. Okay, we've already talked about, introduced the concept of break-even, and so we are still we're now going to talk about basic concepts. So today we're going to talk about break-even analysis, and then we will talk about what do you call it? Sensitivity analysis. Okay. So, and we're going to talk about very basic concept in break-even analysis. So, at what sales level, at what output level is the minimum that we can expect to make a profit? Okay. So now, as you are aware, we're going to also focus strictly on accounting break-even analysis. We can do a cash break-even analysis, but let's begin for us with accounting break-even. Very simple. we ask us, now, in order to do the basic accounting break-even analysis, you have to recognize that generally the production process involves a fixed cost, okay? And so it's possible that, not it's possible, whether or not you produce anything, whether or not you engage in any activity, there's a fixed minimum cost, okay? If you rent space to say, for a retail establishment or to sell goods, let us say you rent space, and the space, let's say on a monthly basis or on a yearly basis, you rent the space for $1,000 a month. So $1,000 is your fixed cost. You have to light the place. You have to maintain the place in other ways. Those are all fixed costs. Now, whether or not you sell anything, whether or not you produce anything, you will incur that fixed cost. So that's standard. Now, there's variable costs, which is a cost that depends on the output level. It could be the number of units sold. It could be the number of units manufactured. It could be the number of customers served. For example, for each, if you're selling something, there's a variable cost because you purchase something for $3 and then you can sell it for $5. Yeah. So $3 becomes your variable cost. In the manufacturing process, you add in the cost of materials, the cost of labor to manufacture, and those become your variable costs. And so the question becomes then, once you break your costs between fixed costs and unit variable cost, that is the cost per unit to produce, to procure, then that becomes a variable cost. And you factor that into your break-even analysis. And so that becomes the starting point. As we said, variable cost is cost per unit, okay? And sometimes variable cost can change as the quantity of output increases or changes. And so we're going to look at a variable cost, a unit variable cost that is constant, okay? Like I said, break-even analysis can be a little bit more complex if you're dealing with nonlinear functions, and that is usually not difficult to calculate. So let's say we have a unit variable cost that is the same no matter how much you produce, but sometimes the unit variable cost can be complex. So as you can see here, the fixed cost, if you look at the red line here, so you have a fixed cost that that it goes up, begins at some point, and I'm going to try to do an illustration, using Excel. And then you have a variable cost, which says that if you produce nothing, if you serve no customer, the cost is 0, okay? And then you can see where the variable cost, the average variable cost and the fixed cost intersect, okay? And so the revenues go from the blue line and goes up, and when the revenues intersect with the total cost, then you have your break-even point. And for this particular problem, the break-even is 12,500. We're going to try to illustrate such a problem, but first of all, we are going to look at the mathematical. Hello.
Recording myself getting mad at my boyfriend for not saying good morning and then.
Please, can you please mute that? I
haven't seen you all morning.
Hello.
You're asking me to drive you somewhere?
Please, can you mute yourself?
Please. Come on. I'll get you in the car.
Excuse me, I'm going to end the class. All right.
I was recording my.
The more boring you are in real life, the less people are in.
One more time. One more time. Please, let's move on. Okay, so let's take a very simple example. Okay, before we get into a mathematical formulation, let's get into a very simple example. Let's. I'm going to stop share this, and I'll come up with a simple example. Okay. All right. As an example, we're going to look at later. Are you seeing my screen?
No, it's not showing anymore, Professor.
All right, I'm going to bring up another screen. All right, so let us say we have a very simple problem, and I'm going to illustrate. We have something where fixed costs, okay, I'm going to call it FC, is equal to, say, 5,000, okay? And so we are looking at something that we buy, and let us call it ball pens, and we buy each one, okay? So unit variable cost, so it's equal to $2, okay? And price is equal to, say, $6, okay? And so price will be P, unit variable cost will be V, all right? All right, so it's very easy. Now, if you come to look at this, we have, say, quantity of output and total cost, okay? And we look at profit, okay? Now, this is unit variable cost. So let us say we start from, say, 0, okay? And say 250. All right. Now, total cost, as we know, total cost is fixed cost plus unit variable cost. So if we produce 0, for example, we have the total cost will be fixed cost, which is 5,000 plus the unit cost, which is 2 times the quantity of output, which is H6. Okay. All right. And so total cost is 5,000, which is the fixed cost if we produce nothing. And we can go on. And so as you can see, total cost increases as the quantity of output increases. Okay. All right, and the profit is revenue minus cost. Yes, revenue minus cost. So in fact, let's create here a column for revenue and then create a column for cost for profit. So revenue is the price times the quantity, and so which is equal to 6 times the quantity of output, which is 6. If you sell nothing, you get no revenues, and as the more you sell, the more your revenues. So we're going to plot all of this. Your profit is your revenue minus your total cost, and so which is J minus, okay. So I'm going to make this $1, and so we go down and see. And so now we can plot, okay. So we'll plot quantity, plot revenue, total cost. As you can see here, let us first of all plot the chart. All right. As you can see here, I'll move this chart so that we can see clearly what we're doing. All right. So as you can see here, the blue line is your cost. Okay. As you can see here, the blue line is your total cost. And let me make this a different color. Line. You can see here, the red line is your revenue line, okay, which is very clearly stated here. And so as the more you sell, the more you produce, the revenue increases, but the cost begins at 5,000, okay? The cost begins at 5,000, which is your fixed cost, and then increases as you increase your sales or your output. But this cost is increasing because your unit variable cost is increasing. And so your cost will also be increasing. And so you have your break-even point. Your break-even point is, you can see, is where revenue meets cost. And so you have your, going to try to increase that. So font color. All right. So it makes things a little bit clearer. You can see your minimum output for you to make a profit, say 1,250. We can solve this mathematically. Okay. So this is a break-even illustration. Okay. It's a break-even illustration. I'm going to so now it's easy to understand what we're doing, but now we can solve it mathematically. The mathematical formula is what I'm going to try to illustrate. I'm going to stop share this and bring up the PowerPoint slide. Okay, so this is essentially what is being illustrated here. Same thing that I just did. We'll go into maybe, let me see if I can bring this up. Okay. Oh, let's have all right. So this is a break even. Illustration. All right. So you just have an additional illustration besides what you already have. And so mathematically, what we're looking at is that we can easily take this problem. As you can see, our break even here was 1,250, as you can see from this chart, it's 1,250. And so we can also look at it mathematically, which is what is illustrated here. Break even Q is equal to, see, equal to the fixed cost. Let me make it very clear. Okay. Fixed cost divided by price minus unit cost. So in this particular problem, we can solve this very easily. And fixed cost was 5,000. And price was 6. The variable cost was 2. And so we have a very simple problem. Like I said, this is a very simple illustration of break even. 6 minus 2 is 4, and which gives us 1,250 units. Okay, which is what we got by solving the problem graphically. Like I said, the problem could be a little bit more complex. If you have a nonlinear cost function and a nonlinear revenue function, you will have two break-even points. The first break-even point is the minimum that you need to produce to break even. And the second break-even point is the maximum that you can produce, and then you start making losses again. Now, the initial break-even point and also the final break-even point in a nonlinear function do not indicate the profit maximizing units if you have nonlinear functions. But we're not dealing with nonlinear functions here. We're dealing with simple, very simple linear function. And so I see the same formula here. The price minus the unit cost, and here is the price per unit minus the cost per unit, was what you call the contribution margin. But that contribution margin can be complex if the functions are non-linear. Okay. All right. So these are other illustrations that you can use, or you can ignore them. Again, this is the formula that we had put up, F divided by P minus V. I think I prefer to replace that. Okay. Okay. F is it a fixed cost? Okay. B is the sale price per unit, and V is the variable cost per unit. And so you have more illustrations that you can use. Okay. Now, we can also do an NPV break-even analysis, but we're not doing that today. If you want to raise some questions about that, get in touch with me, and we can have other sessions that we can use. Okay. Now, the next thing that I wanted to really get into is the sensitivity analysis, which actually is a way to look at the riskiness of a project. There are two kinds of analysis we're going to do, in terms of risk. One is sensitivity analysis, and the other one is scenario analysis. Simulation is where you do numerous, you can say an infinite number of variations, which we don't have time to do now. And then you plot a continuous graph and see, how you have your distributions. Next time, we're going to talk about expected values and the value drivers, okay, in a firm, but we're not going to talk about it today. What we're going to talk about today will be sensitivity analysis. Okay, so next time we're going to talk about scenario analysis. We're going to talk about expectations and probabilities, but let's talk about things that appear to have elements of certainty in them today. Okay. All right. Now, what happens when we do sensitivity analysis is simply that we look at, say, the variable cost. We look at the price. We could look at the quantity of output, which is, actually when you take quantity and price, you're not looking at the revenues. Okay. When you take unit variable cost and quantity, we're not looking at total cost. And we ask ourselves, what if these estimates change? Okay. What if the unit variable cost changes? What if the forecast for sales changes? It could change for the better, it could change for the worse. For example, the quantity of sales that we predict may actually increase, or we can have a problem where we are over optimistic, and then we have lower sales than we had expected. I think I skipped some things here. Okay, I'm going to look at some very simple example. Okay, so I'm going to stop share this and pull up another example of that I'm going to use to illustrate sensitivity analysis. Okay, so just give me a minute. All right, so now here is a simple problem, okay? And essentially, here, we are not only going to be looking at how, and I'm going to just pull up the solution because we're going to have a complex problem. So I'm going to pull up the solution and essentially show you how to go about it because it's going to use a method that you already understand. And so now here is where we're doing a capital budgeting problem. Now there are two problems that you need to be looking at here. First of all, how will your profits change with variations in, say, price, with variations in quantity of output, with variations in unit variable cost. And then when you go from how your profits will change to how your cash flow changes. And also, you go then from how your cash flow changes to how your net present value will change, okay? And see, that enables you to modify or recalculate your profitability index. And so there is, quite a bit to get out of sensitivity analysis. So I'm going to pull up the solution to this problem and show you essentially how to go about it, because you already know how to calculate NPV. And so I'm going to pull up the solution on MS Excel. I don't know if I'm going to be able to put it here in PowerPoint slides. So here is a solution here. Okay, now this is the solution to this particular problem. As you can see, are you able to see the entire thing? Let me reduce it a little bit. All right, can you see it? Hello, guys.
Yes, Professor.
Okay, now you can see that the initial problem, we had projected 125,000 units per period, okay, for 7 periods, 7 years, all right? Of course, the depreciation method is MACRS 5, which you see here, okay? That is the depreciation method. So our revenue.
Wait, Professor, how did you get that part that you just went over, the percentage? What did you use to calculate that?
Okay, now the MACRS is given by law, it's given by Congress. What does it do? What happens is the Congress, through the IRS, has different categories of long-term assets, okay? And so they give those assets categories in years. For example, you have assets that are called 5-year assets. Then there are 7-year assets. Then there are 3-year assets. And then there is 10-year assets. And there's 20-year assets. Now, they are called, the categorizations are called MACRS, which is Modified Accelerated Cost Recovery System, okay? And so now this asset, and I'm going to pull up the categories for you, which is also in the class website. I'm going to stop share this. All right, I'm going to pull up the categories for you. All right. So the Congress has classified assets, okay? And so these are the percentages given by Congress. They are not something that I made up or I calculated myself. You don't have a choice. If your asset is classified as a 3-year asset, then when you get that, if you do your depreciation, you can depreciate 33% of the asset in the first year, 44% in the second year, 14% in the third year, and 7% in the fourth year. And so the asset that I put, the capital budget asset that I pulled up is classified as a 5-year asset. And so this is how I got those numbers. Is that clear? Hello?
Perfectly clear, Professor.
Yes,
Perfect.
Professor, yes, it's clear.
Okay, all right. So I'm going to bring back up the illustration. Okay, so you can see that these are the depreciation rates that I use, and they come from the congressional classifications. Okay, this machine costs 28 million, 200,000 in working capital will be needed. And so the revenues are based on the price, and the price, the selling price is $135 per unit. And when you multiply 135 by the quantity, you get 16.8 million. Okay, and that is constant. It didn't change. It could change. And then, of course, the total variable cost, the unit cost is 37.5 times the quantity of goods. So that gives you the total cost. And so you deduct the fixed cost, you take away depreciation, and you can see depreciation changes. Depreciation changes. Depreciation is the 25% times the total cost of the asset, okay, which is your depreciation. And then you get your operating income, you pay your tax, and then this is income after tax, and then you add back the depreciation, as we know, and then you get your net cash flow. So your initial estimate is that your net present value is going to be 7.794 million. But what if you now change? What if things are different? Now, not if you change. What if things turn out to be different from your projection, your forecast? And that happens quite often, okay? What if sales are better than what you initially forecast? So we simply do another table, and we have the possibility that sales will increase by 10%. And so we have sales now, instead of 125,000, we have sales increasing to 150,000. What if that happens? How would that change your NPV? Your NPV will become 14,791. What if things don't go so well and your sales decrease, and instead of 125,000, you have 115,000? Okay, how would that impact your NPV? So you can see your NPV will decrease by 2.6 to 2.68. Now, the whole idea is that, of course, you use these NPVs to calculate your profitability index and see how your profitability index changes based on possible changes. Now, we looked at only where the quantity of sales change. When you do sensitivity analysis, you're going to look at the quantity of sales changing. Well, what if price changes and your forecast for quantity is the same? If your price decreases, but the quantity of output is the same, or sales, well, that is going to reduce your NPV. What if the unit variable cost increases? That will decrease your NPV. What if unit variable cost decreases? Now, you have different combinations. You have numerous combinations that can occur. This is why we have simulation analysis. But simulation analysis is going to take quite a bit of time to illustrate, and it's not going to be very simple. So any of these variables can change. The price, the quantity, the unit cost. All of them can change. And for example, you can have a decrease in price and an increase in unit cost, and a decrease in quantity. And that's like a triple whammy. And if it happens, you have to ask yourself, is it possible that it can happen? The answer is yes, it's possible. And so you have to do a simulation analysis that has all these combinations, okay? But our purpose here is to illustrate the basic concept and the basic process of simulation analysis, of sensitivity analysis. Now, when you have all these myriad combinations, that is where you do a simulation, okay? And we are not going to be able to illustrate it very easily here, but in practice, you will encounter it. And of course, in this day and age of computers, it's very easy for you to do that. The point I'm making is simply that this is what you have to go through. So you might have to do this 25 times. You might have to do this 100 times, and then calculate different PIs, which is different profitability indices, and then put it on a chart, and then you can use that to look at your options. All right. Is that clear to everybody?
Yes, Professor.
Yes.
All right.
Yes,
So,
Professor.
do you have any other questions?
I don't.
Okay. In the absence of other questions, I'm going to stop the lecture, and I'm going to post this the PowerPoint slides and the Excel files for you to review. All right.
Quick question, Professor. When is the last day for your class? December 12th, December, what is it?
Well, if December 12th is a Wednesday, that would be the last day. Let's see. December 12th is the last day on the calendar. Am I correct?
Next the last Wednesday is
No. What
be
is in
December
the
15th?
academic calendar? What's in the academic calendar?
Yes, yes, Professor.
Is it December 12th? It can't be. December 12th is a Sunday.
Mm-hmm.
Let me see if I can pull up the academic calendar.
It's December 15th, Professor.
Or December 15th. Okay. If it is December 15th,
It's December 15th.
December 15th is a Wednesday, so that would be the last day of our class. Unless I say something different.
Okay.
All right.
Uh-huh.
Okay. So, all right. I thank you all for your patience and your understanding. Next time, we will talk about scenario analysis. We're going to talk about expectations and probabilities. All right.
Yes.
All right. Good night.
Thank you, Professor.
Thank you for
Thank
your
you,
patience.
Professor. Good night, y'all.
Good night, everybody.